All right, so it is 11 o'clock, so we're going to go ahead and get started, keep letting people in. But hi, everyone. Good morning, and thank you so much for being here with us today. I'm Caitlin Walsh. I'm the Member Services Coordinator here at the Frederick County Chamber of Commerce. And today, I'm thrilled to be introducing the wonderful team from Ryan Wetmore. Ryan Wetmore is a full assurance and tax practice providing a wide array of traditional and non-traditional consulting services that help their clients grow and prosper. Ryan and Wetmore services clients whose business activities encompass nearly every state and major metropolitan area throughout the country. Ryan and Wetmore feels that by utilizing their substantial and wide range expertise, they can make a unique and significant contribution to the continued success of their clients. As a testament to the success of their company's mission, Ryan and Wetmore has been ranked as one of the top 50 accounting firms in the DC area, as reported in the Washington Business Journal for 5 consecutive years. Today, we have with us Pete Ryan, CPA and MBA, who co-founded Ryan and Wetmore in 1988, Lori Kubik, CPA and manager, Carrie Karn, CPA and senior manager, and Jack Ramsey, finance consultant. Just as a few housekeeping notes, you will be muted for the duration of this webinar. If you have any questions at all, please do not hesitate to drop them in the chat or our Q&A box. This session will be recorded and the presentation slides will be made available in a post email. So with that, I will go ahead and hand things off to Carrie, who will get us started on the employee retention credit.
Great, thank you, Caitlin. Good morning. We are very excited to be here. We're here to talk about the employee retention credit, and this is potentially a very important credit. And we believe a lot of people have overlooked this just due to its legislative history. You can now claim the credit in addition to PPP. So if you got a PPP fund, you can also claim this credit. And so that's what we're here to talk about today. There have been a lot of changes as it's been rolled out both in December and then this year that have really expanded the program. And so we believe a lot more businesses are eligible that previously might not have been eligible. So we really hope that today's presentation will help to explain how it might benefit your company. So like Caitlin said, please be sure to post any questions in the chat feature. We'll have some time for those at the end. Ryan and Wetmore was started over 30 years ago. Pete Ryan, one of the founders, is here with us today. The two founders left larger firms to be more proactive and hands-on with their clients. We have 3 locations, Frederick, Bethesda, and Vienna. We have been in Frederick for over 20 years. Our office is currently in the office buildings in the Spring Ridge neighborhood, just east of downtown Frederick. So we do serve many clients across Frederick County. We have about 40 employees made up of accountants and also consultants. And for the past year, we've been helping clients get through the pandemic and trying to maximize their government assistance and relief. We want to quickly tell you a little bit more about our team. First, we have Pete with us, one of the partners.
Yeah, hello, everybody. Happy to be here. It's been a crazy 13 months. We've been cooped up or whatever. And the employee retention credit, we've been working on all kinds of government programs. Most overlooked thing where, clients are getting hundreds of thousands of dollars depending on the side. Happy to be here.
We also have Lori with us.
Welcome, everyone. My name is Lori. At Ryan and Wetmore, I specialize in working with business clients in all aspects of their business, from the initial setup of their accounting system to support with their accounting and payroll functions.
And also Jack is with us today.
Hi, everyone. I'm Jack Ramsey. I'm a finance consultant with Ryan and Wetmore. I specialize in maximizing our clients' relief and building models to help clients maximize their relief across different programs such as PPP, ERC, and others.
Great. And I am Carrie Karn, a CPA, and I work closely with growing businesses, helping you with your financial statements, tax returns, tax planning. I just want to make sure that you understand where your money's coming in and going out. So for today's presentation, we'll go through a number of topics, all regarding the ERC. We're going to walk you through what it is and the legislative history, which has been changing rapidly. We'll also talk to you about eligibility, who is eligible and how much you might be eligible for, how much you could potentially qualify for. We will go over how this interacts with other funding that you might have received, like the PPP loan, talk about some of the documentation requirements and the next steps for claiming the credit. Like I said, we will have some time at the end for questions, so please keep those coming in. If something doesn't quite make sense or you want more information, just let us know.
So let's start off with what ERC actually is. So ERC is the Employee Retention Credit. So it's kind of confusing, but essentially it's not related to PPP. It's not a loan or a grant. It's a fully refundable tax credit. And now, in fact, you can get PPP and ERC due to recent legal changes. So essentially, the Employee Retention Credit reimburses employers for qualified employee wages. So it's very lucrative for businesses that qualify. And as you get more credit, it nets against your employer side Social Security tax. So basically, we've seen some people be confused thinking they might not be eligible if they don't have taxable income in the year that they claim ERC. That's not true, because everyone is eligible, potentially eligible for ERC, regardless of if you have taxable income, including PPP borrowers. So now, due to recent legal changes, it's been extended through the end of 2021. So it's going to be here for a long time to come. So to get into some legislative history, we've seen a lot of clients be confused thinking they might not be eligible because they have a PPP loan. That's not true. Originally, when the ERC was created in March of 2020 with the CARES Act, it did say you could either have ERC or PPP, but not both. However, in December, that $900 billion stimulus bill extended ERC through the first and second quarters of 2021, made it a lot more valuable, which is huge. We'll talk about that. And it also said that retroactively, you can do both PPP and ERC as long as you don't double count wages. You can't use them on both, but we'll get into that later. And now just recently with the American Rescue Plan Act, it again slightly improved and extended ERC through the end of 2021.
Who is eligible for ERC? Well, you need to meet one of these two scenarios. You have to be, your business would have needed to be fully or partially shut down by a government order due to a pandemic. This would include if your business was subject to capacity limits or reduced operating hours. And the second criteria you could meet is if you had a significant decline in gross receipts in a quarter compared to that same quarter in 2019. Remember, this is an either or, not a both. And we'll define significant decline in a few slides. It's really easy to get lost in the weeds regarding the rules about government shutdown criteria. So if you have any questions or need additional information or want Ryan Wetmore to help you determine if you qualify, please give us a call. How much am I eligible for? In 2020, the ERC will reimburse employers for 50% of qualified wages, and qualified wages are capped at $10,000 per employee for all of 2020. So this translates to a $5,000 per employee credit. The new legislation was much more generous in 2021. So the ERC will reimburse employers for 70% of qualified wages, which are capped at $10,000 per employee per quarter. So this translates into a $7,000 credit per employee per quarter, or a $28,000 annual credit. Qualified wages are defined as gross wages, which are subject to Social Security taxes and allocable group health benefits. Some businesses can qualify for the ERC beginning in the third quarter and fourth quarter of 2021 that previously did not qualify, and we'll go over those details in a few upcoming slides.
What is the change in 2020 versus 2021? Well, so there's a lot of changes that went over, and we'll try to walk you through them. So the first one is In 2020, employers of any size, including tax-exempt organizations, were allowed, but not government entities. In 2021, same deal, employers of any size, including tax-exempt organizations and certain public entities, and employers that did not exist in 2019. So it opened it up for, a bunch of large sort of healthcare hospitals and certain public entities. So again, that was the first thing they did. As Lori sort of mentioned before, in 2020, you had to have 50% decline in gross receipts compared to the same quarter in 2019. Okay, in 2021, you just have to have a 20% decline in gross receipts. Okay, so it's a huge change in what occurred here. So you needed a 50% decline versus a 20% decline. So we're having, I would say 2/3 of our clients who expect to have at least one quarter in 2021 that is less than 20% of their 2019. So you have to compare that quarter. It's a huge change. And as Carrie mentioned, you can now do PPP and ERC. So it changed the game for us in the beginning of January. And you may elect to use a prior quarter gross receipt. So what does that mean? So if you were down 20% in the fourth quarter 2019 to the fourth quarter of 2020, you can make an election and you can claim ERC for the first quarter of 2021. And so if you're down 20% in the first quarter 2021 compared to the first quarter 2019, make this election, and for second quarter, you can claim ERC. And so one of the big changes, I'd say the biggest change was the 20% versus the 50% decline. But the second largest change in 2020, you're allowed a $10,000 per employee annual limit. So you get 50% of $10,000 in 2020. That's a $5,000 credit. In 2021, you can get $7,000 credit because it's 70% of 10,000, but you can get it every quarter. So you basically can get it for, $28,000 a year. We have some clients that are going to get over $1 million because we already know 2021 on every quarter is going to be less, 20% or less than 2019. And so another large change is in under the original plan, if you had 100 or fewer employees, okay, whatever wages you claimed, you got the credit for. You get a $5,000 credit up to $10,000 in wages. And if you were above 100 employees, you can only get a credit if you paid people to not work. In 2021, they raised this limit from 100 to 500. So again, they expanded it and made so many more employers eligible. So that's huge. It changed our world. Again, that we mentioned, the credit went from 50% to 70%. And then they added, certain things that, were now, certain wages are now qualified. If you pay people more for hazard pay and things like that, that worked as well. They also changed the definition of gross receipts. So again, it's just been an altogether huge change for almost all of our clients.
There are new eligibility opportunities in the third and the fourth quarter of 2021, as I alluded to in a previous slide. If you're a recovery startup business, that's a business started after February 15th, 2020, and your average annual gross receipts are $1 million or less, you can qualify for up to $50,000 per quarter credit. And for severely financially distressed employers, these are businesses that have had a 90% decline in gross receipts. The employee size requirements don't apply. So any wages paid to an employee during any quarter are qualified wages. Note, though, that these changes only apply between June 30th, 2020 and July 1st, 2022.
So let's go into a little bit more detail on PPP and ERC and the interaction. So can you do both? As we've already said several times, yes, you can get PPP and ERC. So essentially, when you decide which payroll you want to use on each program, you've got to be careful that you don't double count. So this applies to PPP, ERC, and FFCRA. You've just got to use different wages on each program. It's really important not to double dip. So we see a lot of clients getting tripped up there. So let's talk about some best practices. So if a borrower, so if you have not yet applied for your PPP loan forgiveness, if you have a PPP loan, if you think you might be eligible for ERC, then you may want to consider getting the maximum possible amount of non-payroll costs in your forgiveness application. So if you're familiar with PPP forgiveness, you'll note that you can use up to 40% non-payroll costs by using that maximum 40% or as close as you can get to it. Essentially, you are maximizing the amount of PPP or the amount of payroll costs that you could potentially use on ERC on other programs. It's kind of confusing. We do this every day, so it's not that confusing to us. So, you know, as Carrie said, feel free to give us a call if you're confused about these programs. We've been helping a lot of clients with this. So another thing you'd want to consider is with recent legal changes, you can choose the covered period as long as it's between 8 and 24 weeks. And that can affect everything from your FTE reduction quotient in your PPP, the penalty you get. It can affect your wage reduction calculation. All of these complicated calculations, you've got to consider how the covered period would affect that and potentially impact the amount of wages that you have left over to claim ERC on. Another thing is if you do claim both PPP and ERC, or if you claim two of these programs where you can't double dip, you've got to have documentation that shows you're not using the same wages on multiple programs. So there was a recent IRS update, IRS Notice 2021-20 on the interaction between PPP and ERC. So essentially what we saw back in 2020, like we said, originally PPP borrowers could not also get ERC. However, now PPP borrowers can retroactively claim ERC in 2020. However, a lot of PPP borrowers just listed all of their payroll costs that they possibly had in the covered period on their PPP forgiveness application, even if they weren't necessary to get full forgiveness. And what AICPA, the American Institute of Certified Public Accountants, asked IRS to do was to clarify that wages are potentially eligible for ERC as long as they weren't necessary for full forgiveness. So if you listed wages on your PPP forgiveness application, as long as you didn't need those for full forgiveness, you could potentially turn around and use those on ERC. However, the double dipping rule still applies. So you can't use them on ERC if you needed them for full forgiveness based on what you had on your application. So the IRS basically said, yes, they agreed with AICPA and they said you can use payroll costs listed on their PPP forgiveness application. You can't get back some of those costs as long as enough are left to substantiate the full amount of forgiveness that you received. So this brings up another complicated question. How do you maximize relief in these multiple complicated programs if you can't double dip? So the no double dipping rule applies to ERC, FFCRA, the Provider Relief Fund if you're a medical provider, PPP and others. So how do you ensure that you don't double dip and you maximize forgiveness? To give you an idea of what we're doing to bridge this gap, for larger clients, especially larger clients, as well as clients that participate in multiple programs, we may need to build complicated models to maximize the amount of relief and also reconcile payroll and make sure that we don't fall foul of those double dipping rules, because that's really important. So some of the things that we model to give you an idea is average monthly FTE, full-time equivalent, wage reduction penalties in PPP, average hours, and other complicated calculations. It seems really overwhelming, but with these models that we have, it makes it a lot easier. And we do really think that these multiple programs call for an integrated approach.
Unfortunately, the IRS has said that self-employed individuals are not eligible for ERC with regard to their own self-employment earnings. However, if they pay wages to employees, those wages may qualify subject to the normal requirements. The IRS has released guidance on what documentation needs to be maintained to claim the ERC. You need to document your eligibility. If you received a government shutdown order or documentation that you were affected and gross receipts calculations, you need to keep documentation of your qualified wages. Most payroll providers have created reports for this purpose. As Jack mentioned earlier, you have to keep track of which wages were used for other programs like PPP or others. You need to keep track and document how you determine what your qualified health plan expenses were or whether you were part of an aggregated group. You need to keep copies of your quarterly payroll reports, like your Form 941 and any amendments to that form on Form 941X.
So next we're going to look at how to claim the ERC. There are a few different ways to essentially get your money back for this credit. And so generally it is going to be on your employment tax return. So your quarterly 941s for your payroll. So if you are eligible for a credit in 2020, you've likely already filed your quarterly payroll tax return. So what you would need to do is just file an amended return. So that's pretty much the easiest way to do that. But you would need to coordinate with your CPA, your payroll provider, your office administration, find out how much of your wages qualify, and be able to prepare the amended form. And so then looking at 2021, you have a couple different options. So for 2021, you likely haven't filed your quarterly payroll tax return yet. So for the first quarter, we're kind of looking at that now. You could claim it on your original quarterly 941. The second option would be to stop making your payroll tax payments. So if you do qualify for the second quarter, so we're in the second quarter now, and you find that you do qualify for the second quarter, you can stop making your payroll tax deposits. So that gets you your money back in your pocket quicker. Instead of paying it in and waiting for a refund, you're just not paying it in. And so that's a little bit quicker if you are looking at a quarter that you currently qualify for. And then the third option is to file Form 7200 for an advance of the credit. So you might be looking at, second quarter 2021, you're saying I do qualify, but the credit that I'm going to get is, way higher than these payroll tax deposits that I would usually be making. So they're essentially going to owe me money back. And so you can file this Form 7200 to request that money back sooner. So you don't have to wait until the end of the quarter, file your 941, and then, get your money 45 to 60 days after that. You can go ahead and file the 7200 now and get your money quicker. So these are all really great options to, like I said, keep that cash in your pocket. The idea behind the credit is that the government is really trying to keep everyone working. So keeping people employed, keeping businesses active, and so that as we recover, it's easier to get back into it. So then looking at whether you are eligible, first talk to your trusted advisor. Could be your CPA or whoever your advisor is that you normally talk to. Like Jack was talking about, this can get a little complicated with the coordination with other relief. So, if you did receive a PPP, you just want to make sure you don't double dip, just coordinating that with everyone. Next, you're going to need to know your accounting method, whether you're cash or accrual. A lot of businesses are on the cash method unless your gross receipts are over 25 million, or you might have checked the box to be on the accrual basis. And so that cash or accrual is going to be the determining factor as far as then calculating your revenue per quarter. So next, you're just going to be doing the math. So you're going to calculate your revenue for each quarter and then do some comparisons. So first you might look at, the quarter that just ended. So first quarter 2021, you're going to compare it to first quarter 2019. see what the percentage decline is, or, hopefully you don't have a decline, but if you do, if it's more than 20%, you're eligible for this credit. So you want to, work on getting that money back. Then you could take a look at the second quarter 2020 to the second quarter 2019. If there was a greater than 50% decline, since it was, the old rules in 2020, then you would be eligible, and so on and so forth. You're just going to take a look at each quarter to find out whether you qualify there. It's straightforward once you have all the numbers, just doing the math. And you do want to make sure, like we said, with the various relief funds. So PPP funds are not included in revenue, so you're not going to include those in your numbers. But you could have received other relief that might need to be added into your revenue. So you just want to, take a look at what you did receive and make sure you have the right numbers there. And then if you were subject to a government shutdown, you want to find all of your government shutdown orders. This could be a full shutdown or a partial shutdown. And you just want to find out the exact date. So when did it start? When did it end? And go from there. So if you are eligible, the next thing you're going to do is gather all of your payroll information. So now you know which quarters you are eligible for, and you're going to start looking at your payroll for those quarters. So like Jack was saying, if you did receive PPP funds, you do want to make sure you don't double dip. So, maybe you figure out you're eligible for this first quarter 2021. Maybe you got a second round of PPP funding. And so you just want to make sure you don't overlap those. You can get, both of them in the same quarter, but you just don't want to use the exact same wages. Obviously, there's, more than 8 weeks in the quarter. So there is possibility to use both. Let's see. And so then you would be looking at filing, amended returns or filing your 941 for that quarter to claim the credit. We generally think most of our clients did have some kind of shutdown in 2020. And so if you did have a shutdown in 2020, you don't have to meet the 50% decline limitation. So it is kind of an either or scenario there. So if you had the shutdown and still, your revenue was about flat, you still qualify. So then with the PPP loan, the government essentially gave you 24 weeks to pay 8 weeks of payroll. So, even though it covers the 24-week period, maybe you didn't need all 24 weeks to get your forgiveness. Maybe in 8 or 9 or 10 weeks, you had used up all your PPP funds. And so then you could go to looking at this credit. And so if you kept the same number of employees employed those whole 24 weeks, you could get both possibly. Just making sure you document so that you don't double dip. And then once you have filed either your amended return, your 941, or your advance request, you're just waiting for the money to come back to you. It could take 45 to 60 days to get that money back.
So, right now, what Carrie talked about is file form 7200. So this would be in the scenario that you're really cash strapped, and just say you had, $100,000 in wages that were eligible, you'd get $70,000 in credits, and you only had $30,000 in withholding tax, both employer and employee. So you could file this form and ask the government, hey, send me the difference, between the payroll tax deposits I'm supposed to make and the amount of credit I'm supposed to get. So please, fill out this form. And they would, in this example, they would send you 70,000 minus 30,000. They would send you 40,000. They were getting these things processed in 45 to 60 days. It's been a little bit longer recently because more people are finding out about the credit. All right, things to avoid. Okay, this is where it gets interesting. Not having a plan. So you should definitely figure out what, as Carrie mentioned, figure out what your gross receipts are, figure out what your payroll has been, and then, come out together with how you're going to go tackle this credit, how you're going to plan for it for 2020 that's already occurred, and 2021, which we just started the second quarter. And then not having documentation. Some people are just putting things on the forms and not having documentation. Big problem is there's a lot of vagueness around what is a temporary shutdown. So people are not saving government orders and other documentation. As Jack alluded to, not considering when PPP loan when applying for employer retention credit. So you could have your payroll company or your accountant do the ERC credit, and then you can have somebody totally different do the PPP forgiveness loan application, and they both count the same wages, and technically that's fraud, and you can either have to give up back the money or so. So you have to document it. It gets a little convoluted when you have to figure out FTE counts and the more employees, but again, if you come up with a good plan, then you can sort of map all this out. And not involving the payroll company at the beginning and just figure out what information that they have that they can download to you. Some payroll companies have their act together, some don't have their act together at all. And so you got to figure out what we're doing. So figure out who's on your team and sort of get started. Excessive fees, there's some bad actors out there, as I call them. You know, we had a client who somebody does their RD credit, and we'd already done their ERC credit for the first quarter. It's about $280,000, and they wanted to send them a one-page addendum and charge them like $90,000 to go compute this. So just make sure that you're probably better off going with your current accountant, someone like us, or so your payroll company, and not signing up for a credit per money saved. The other mistakes we're seeing is people don't understand the applicable quarters that are out there. They don't understand what a temporary shutdown was almost 13 months ago. It seems like 5 years ago, but should figure out what quarters and come up with a game plan. And then there's not reconciling advance payments from the Form 7200 I showed you earlier when claiming the ERC credit.
The flowcharts on the next 3 slides are a summary of our discussion so far. They guide you step by step through the eligibility criteria for each year. I'm not going to review all the steps today, but you can download the slides presentation to review these at your convenience. We have identified, though, through the bolding and the underlining of what changed year to year. So if you want to flip through these, in 2021, in the first 2 quarters, the changes are underlined. And the credits are underlined and bolded. And then in the second and then third and fourth quarters of 2021, those additional changes are bolded. They apply to, the businesses that have additional changes.
Awesome. So we do want to take a minute. If you do have any questions, feel free to put those in the chat feature. And just reminding everyone again, we are a Frederick-based firm with professionals who are working on these issues with our clients. Or if you do happen to have friends who are in Montgomery County or over the river in Virginia, we have offices there as well. So we are working with our clients, walking through the flow charts, allocating wages, really making sure we're trying to do our part in this COVID environment to make sure that everybody's getting access to the benefits that they qualify for.
We have one question. Is the credit for both employer and employee tax?
I mean, the answer to that question is, so it's 2 parts. So the credit, you can use the credit to reduce both employer and employer tax. So that's pretty straightforward. Again, if your credits are greater than all your taxes, you'll get the money back either on a 941 or on a Form 7200. But as far as what qualifies as wages, employer taxes don't qualify for wages. Some health costs do, but it's employer payroll taxes do not qualify for the computation of how we do the credit. But you can reduce the payments, of the taxes by the credit.
All right, does anybody else have any more questions? Are you eligible if there was no loss in revenue, but you employed certain people who did not work full-time, but were paid full-time wages?
I mean, if you're under 100 employees, it doesn't matter. If you're under 100 employees in 2020, it doesn't matter. But if you're eligible, if there's no loss in revenue, so you wouldn't qualify for the ERC in 2020 or 2021 unless you had a government mandated shutdown. But there are some other programs that you might be eligible for certain people who do not work full-time, but were paid full-time, but not under this plan kind of deal. You need a revenue reduction.
Do we qualify for the first quarter of 2021 ERC if the fourth quarter 2020 revenue decline was 20%, or does it have to be 50% or more?
The answer is yes, you would qualify. You have to make the election. Am I correct, Jack? You can chime in here.
Yeah, so you would qualify if you hit that 20% decline. On the other hand, if you happen to hit a 50% decline, you could qualify in the fourth quarter of 2020 and the first quarter of 21. But if you just wanted to qualify for the first quarter of 21, that 20% in the fourth quarter of 2020 is sufficient. So I also see a question that I can answer really quickly. What exceptions are there for family member employers, daughter and myself? So it's a little bit complicated for the owners themselves. If you're an owner that got paid W-2 wages, are those wages eligible? The IRS actually surprisingly has not specifically addressed this. However, we think that this calls for a conservative approach because the law says that it's for employees. So we do not count owners as eligible for the ERC. On the other hand, if there could be guidance on this in the future, and we would look out for that. However, what the IRS does say specifically is that individuals, certain individuals such as children that are related to the owners, either directly or by attribution, those children and those related individuals are not eligible for the ERC for their own wages. So your daughter, unfortunately, if you are over a 50% owner, is not eligible. Yourself, probably not eligible as well, but we're waiting for IRS guidance on that.
But we're also saying if you're under 50%, we're considering you eligible as far as ownership goes. But in either scenario, we're not counting children of any owners.
Yeah, children of owners of over 50% are not eligible. That's correct.
There's another question about whether we have an Excel spreadsheet template that we can provide to help people calculate the ERC.
We've sort of developed spreadsheets for each individual client. So we can sort of, give you an idea offline about how to go do this, and that would make more sense. But you can email us later on and we can show you how we do this. But we would start with coming up with the payroll from the payroll company by week or by payroll period for 20 and 21, and then trying to map out, okay, we're including this revenue, these costs for PPP and these costs for ERC. So it's a little complicated, but we start with a download from payroll information once you've determined you're eligible.
All right, any other questions?
I'm not seeing any other questions, so we can go ahead and wrap up. Thank you all for attending today. Please feel free to reach out if you do have questions afterward, and it was great to see everyone.